Earnings season is almost over and outlooks are actually improving. Analysts have stopped cutting their earnings estimates in the past few weeks. So what does this mean for markets? Joining us now, we got Kelly Kowalski, MassMutual Portfolio Manager. Kelly, really appreciate you making the time for us. What exactly is driving this renewed optimism, or at least decline of pessimism, about earnings growth for the rest of this year?
Well, good morning, Madison. Thanks for having me. I think that we've seen sort of as Stephanie remarked earlier, a big sort of U-turn from the administration in terms of a softening in policy. More encouragingly, we've seen an administration that is reacting to data and markets to some degree. So it feels like we've escaped from the worst case scenario. And I think if we can sort of get more clarity on what the trade situation is going to be, what this bill is going to look like, we may be able to sort of muddle through the next few months. If you look at overall S&P earnings, we're down to about 7% for the year. So there is some sort of already of that tariff sort of downside and the policy uncertainty baked in at this point.
And when you think about that policy being baked in, is that true across the board for stocks? I was reading a note this morning that tried to kind of differentiate between consumer-facing stocks versus CapEx-facing stocks, those big tech stocks that really rely on just company expenditures. Is it true for both of those different groups of companies that they are post-tariff in this environment?
Certainly, no, that's not what we're seeing. I don't think you can sort of bake in this level of uncertainty that we've seen. It's very unprecedented from the last several years. We know that companies have withdrawn guidance. Analysts are sort of doing the best they can to predict. Companies are still sort of frozen in terms of a lot of CapEx decisions, hiring decisions. But I think we kind of know at this point the overall tariff rate is probably going to settle somewhere around 15% overall. So that's probably where the market is feeling things right now.
So do you think looking ahead, the risk is that we could see surprise on the upside because all the bad news is baked in, or is it the opposite? As we actually get the impact of that 15 percentage point higher tariff rate, companies have to actually feel that in their earnings.
Certainly, we've seen quite a bit of pessimism, and I think the bears, especially over the past several weeks post Liberation Day, have been proven wrong. So yeah, I think there is sort of an upside risk there as we think about getting past the trade uncertainty, getting the bill passed, thinking about potential productivity gains as we think about AI and those types of improvements, which again, the time horizon is sort of uncertain there, but let's not forget that that's an overall tailwind as we think about the long-term economic outlook.
So when we think about the bill, honing in on that a little bit more, what areas of the market does that benefit most? Do we see it this year? Is it next year? Or is the impact not really that big and visible?
Well, I think there's two sides we have to talk about the bill. So we, at MassMutual, we're very focused on fixed income. So certainly we get a little bit nervous about the bill increasing the overall U.S. debt, which it is going to do to some degree. So we do see that as a risk to Treasury yields. We've seen the bond vigilantes are back. Certainly, the most beneficial impacts are from the accelerated depreciation, expensing of R&D, and then the consumption boost. We'll see that's TBD in terms of where the deduction ends up, whether we get this temporary boost in the child tax credit. I think a lot of Republicans in the Senate are certainly focused on that increase in the debt, as I alluded to. So that could change certain things like the SALT cap deduction and such, as they try to save some money and not run such large of a deficit over the next several years.
And Kelly, I am curious how you are thinking about the fixed income space a little bit more in regards to specific companies. In the notes that you sent over, you talked about Walmart as a potentially attractive opportunity for some investors. Talk to me about why.
Yeah, if you think about the MassMutual general investment account, we have a $285 billion account, and it's primarily high quality fixed income. So, and 95% of our bond portfolio is investment grade. So when we think about tariffs and uncertainty, we're bond investors. So is a company like Walmart, is our tariffs a challenge? Yes. From a credit perspective, is someone like that going to be able to weather the storm? Yes, they can. And we invest that way from sort of a long-term perspective. And when we make a credit investment, we're really thinking about what's the worst case scenario, and that's how we've weathered many different crises throughout the past several years.
And when I think about a company like Walmart too, I think about the kind of bifurcation of the consumer. And it was really interesting reading about how you do still see continued strength amid that higher income group. Is there anything that puts that higher income group at risk, or is that a narrative that investors can really continue to sink their teeth into?
Absolutely. You make a great point. The top 10% of income earners is driving 50% of consumer spending. And we've seen this trend, continue for the past several months. Certainly the lower income consumer is still struggling with higher prices and, potentially higher prices coming further with tariffs. We do see that trend hanging in there. Obviously, we have seen consumer spending soften a bit. I think we're encouraged with the markets going up post-Liberation Day. We know the wealth effect has been a big driver of consumer spending. So in the short term, we would expect that to continue. But what is holding this all together is really the labor market. And as long as the labor market hangs in there, we think that the consumer, which makes up 70% of the economy, can sustain.
What are your expectations for the labor market? Do you think it should continue to hold up? And then from a price perspective, when are these prices going to hit? And is that going to become an issue that derails the consumer?
I think similar consensus, we do expect to see a softer labor market as we get into the later months of this year. Think sort of, 50,000 to 100,000 average monthly payroll gains. And that's consistent with, the softened growth outlook that consensus has, as well as you saw the OECD just came out this morning with revised down growth forecasts. And that's what we'd expect against this lower growth backdrop. From an inflation standpoint, I don't think we've seen sort of the real impacts of tariffs come through yet to overall economic data. We may sort of see a one-time rise, as certain Fed officials have alluded to. But the hope is that that is not a persistent rise. You would view it as sort of a one point change or 1 point in time change in the price level.